Hi, everyone. For those that are in the waiting room, we're just waiting for a few more attendees and then we'll start. Thank you for joining us, by the way. We'll be with you very soon.
We're just waiting a few more minutes for more people to join in.
Okay,
Okay.
go for it,
Well,
Lou.
welcome everyone, and thank you for joining us today. We'll be recording our webinar and we'll share this with you. I'd like to introduce our presenters, Harry Pontikas, Director of Chocolate Money, and Tony Dimitriadis, Director of Ad Partners. Tony and Harry bring a wealth of experience in finance, lending, and accounting for builders, and we're excited to have them share their insights with us today. Throughout the session, we encourage you to type your questions in the chat box. We'll answer as many questions as possible at the end of the presentation. Harry, do you want to take over?
Sure. Thank you, Louisa. Uh, G'day, everyone. How many builders here worked harder this year but didn't make more profit? Want you to think about the question. Okay, there's a few. Hmm. So, Louisa, next screen. Okay. I'd like to welcome everyone um, and just say that it's been quite a challenging year for many people. And hopefully today the webinar is designed to alleviate some of the stress and the pressure that you felt, and hopefully provide some future opportunities and direction for you. So the things that we'll cover today is we'll do a reality check on where you are right now. We'll do a build a business scorecard and see how, and you can rate yourself. And then we'll move from pain to opportunities for the new year, especially in light of the capital gains taxes and negative gearing changes that the federal government has bestowed upon us. Great surprise, that one, and it's put the pigeon amongst no the cat amongst the pigeon, I think is what they say. And the next steps and how we can help you and how you can also help yourself. So, as Louisa said, we're here with Tony Dimitriadis from Ad Partners, whose firm specializes in helping builders with their accounting and financial challenges. I've worked with Tony for many years now and know him to be an expert in this area. And Tony, can I throw it over to you? And probably you're best placed to answer the question of some of the biggest challenges that builders have faced over the last 12 months.
Yes, thank you, Harry, and great to be here, and great to see the attendees join us. Um, Maybe we can flick to the next screen and talk about the reality check. So this will be no surprise to most of you, or probably all of you. There have been many challenges The first one there is rising material costs and labour costs, and we all know that the price of timber, steel, concrete, finishing costs have all increased. Supplier price increases continually happen without notice. There are longer lead times. There's greater volatility with the pricing when you're yourself pricing at a fixed price contract for builds. On the labour side of things, obviously increased wages, higher subcontractor costs, greater competition for skilled labour. So all of these things have really impacted your primary costs for the actual construction. Then we have the delays, and there's many delays that you will see in any particular project. So whether that's council delays, whether it's architects, engineering, whether it's delays due to labour shortages, material supply delays, client-driven delays because of variations or the like, finance approval delays, weather disruptions. So as a builder, you're getting it from all quarters, which and a lot of those things are outside of your control, which is quite difficult to manage. We have clients themselves wanting a lot more and typically for less. So their expectations for faster responses, more detailed quotations, more frequent project updates, greater transparency. So they're placing a lot of pressure on you as well.
Quite often, Tony, with client expectations wanting more for less, it's as a result of the clients not organising their finances appropriately. So quite often the builder will just say, "I'll go get the loan from your bank." The client will go to their bank, and their banks are quite conservative at this point in time with the amount that they'll lend out. But not all banks or lenders are created equal. So if the client goes to their bank and their bank says, "Oh, we're prepared to give you this much," and it's less than the construction contract, the client doesn't moderate their expectations. Quite often what happens, the client will go back to the builder and say, "Oh, can you cut your profit margin?" Which is crazy. And builders, being the type of people that they are, that quite often are very accommodating, will even entertain building the same home to the same specification, but for a lower profit margin. Also, the builder often will take into account that no, they've locked in this project. So when the customer comes back and says, "Oh, I thought I'd be able to get that money, but haven't been able to, so I'm $100,000 short," the builder in many ways is up with his back against the wall and has no choice but to negotiate. So my suggestion is, if you take control of your clients, maybe give them a strong recommendation that they go to an experienced finance brokerage, or to Chocolate Money if they don't have a finance brokerage on hand, not to go directly to the bank when they're going for their approval or pre-approval. Sorry to interrupt.
No,
Yeah.
that's a great point, Harry. And it's one that sometimes does get missed and can cause significant strain on the build itself. The other item there, and you touched on the government before, Harry, a potential unintended consequence of the large big build projects that the government has initiated here in Victoria in particular, has put a real drain on labour, and we've seen many trades go to these big build projects. So builders are missing site supervisors, project managers, estimators, carpenters, concreters, etc., because they're gone off to work for the government on higher wages, potentially more job security, definitely more overtime opportunity, and overall larger employment packages. So builders have found it really difficult to then get good quality trades on their jobs, or even for those that employed directly, some good employees.
It's crazy to think that the biggest competitor for builders is the government, that's crying out for more homes to be built, and yet is undermining and sabotaging the very industry that is the only industry that can actually help them build more homes.
Yeah, absolutely. And one might suggest that they probably didn't need to do 4 or 5 major build projects at the one time. They probably could have staggered that, and everything could have been a little better planned. The other item there is cash flow pressure, and it's probably one of the largest, to be truthful, and we see it quite often with builders that they're required to pay their wages, pay their subbies on a regular basis, weekly, fortnightly. They're in many cases required to pay and purchase their materials up front, and sometimes fund variations until they've been approved. They've obviously got to pay their GST, their superannuation, their tax obligations. So cash flow pressure comes by the fact that they need significant working capital to keep a job progressing, whereas they're getting staged payments based on a completion of that job. And as we know, they need to make sure that the QS is ticked off to be able to actually get the full payment of that stage payment.
Yeah. And also, the problem with cash flow pressures, which is common within the industry, is that you don't know the cash flow pressures when they're coming. So all you need is a couple of interruptions, a couple of clients not being able to pay on time, or even the bank deciding that they want extra things that weren't part of the contract to be included for that stage. And all of a sudden, the poor builder's sitting there carrying a cash flow deficit. It's really a tough gig, cash flow in the building industry. And the worst thing about cash flow is once you're getting close to running out, not many lenders will be excited to help you out. So if there's one piece of advice you're going to take out of today's session, from me at least, it's the best time to cash up is when you don't need it. So when you're fully funded, you've got all the money that you need, that's the time to build a cash safety net for your projects and also running your business.
Yeah, absolutely. Absolutely. And the final one there is burnout. And again, we've seen that over the last 5 years where, today's builder is expected to be the business owner, the project manager, the estimator, the salesperson, the HR manager, the accountant, the client relationship manager, the problem solver, and, in many cases, all in one day. So that has a real impact on their decision making, the project outcome, the team culture, the client relationship, and even their family life. So, if you're experiencing all of these issues, in a lot of cases, it just falls back on you, and because you're the builder, the buck stops with you. And, it's not surprising that there have been builders who have, at the completion of a particular project after, many years banging their head against the wall, sort of throwing their hands up in the air and say, listen, I've had enough. And, we've seen that, and that's really unfortunate. But, the trick here is obviously to try and make sure that we've got as many of these things under control as we possibly can that are in our control, and to be planning for it. And hopefully some of these issues and stresses will dissipate a little in time to come.
Thanks, Tony. Louisa, did you want to put up a poll next? Oh, we're doing the business scorecard, sorry. So Tony, do you want to find which areas and identify which areas are the majority stress areas? What would you think out of these areas? The top 3 stress areas.
Did you want to run the poll, Harry?
What do you reckon, Tony? Do you want to say it first, or we'll run the poll first?
Oh, let's run the poll.
Okay. If Louise is going to put up a poll. For those of you that are inclined to nominate your top 3 stress areas, please feel free to nominate. For the others, that's okay. You don't have to do it. One more minute. And if you find that all of them are your stress areas, that's okay as well. Okay.
I'm going to end the poll now.
Yep. Tony, what do you reckon are the top 3 stress areas?
Well, the top 3 stress areas that we see definitely cash flow would probably be our number one. We do find that the other one is sort of the pipeline and the future work, and finally the work-life balance. And I see the guys have sort of rated a couple of those. Cash flow and productivity. Some might think go hand in hand, but generally actually don't. And you can actually have a profitable business on paper, but still run into a lot of cash flow problems for those reasons that we outlined a bit earlier.
True. It's the cash flow is something which is tricky as well, because you can take a snapshot on day one and you could be a millionaire, and then you take a snapshot of your bank account day 3 and it's all gone out and you're actually in deficit. So cash flow is quite challenging to run.
It absolutely is, and you really do need to be managing that closely. You do need to be forecasting that, and I know that sometimes that can be difficult, but you need to be, giving it your best shot. You generally know what is required for the job, what you've spent to date, what you've got to spend, to come. You understand where your invoicing is at, and what we do along with the cash flow is look to report and manage the builder's work in progress and their WIP, because that can generally show where things are at in terms of the job and whether or not it is potentially likely to run over or end up being a good result. So I know it can be not particularly exciting for builders to delve into numbers, and I appreciate that. But you really need to, right from the actual quote, of course, that you're making to make sure that you've covered yourself thoroughly, right through to completion, and really digging deep into those cash flows. So if there might be a problem in a week, 3 weeks, 6 weeks time, that at least you've got a chance to do something about it. Whereas, once you've run out of the money and, the job grinds to a halt, that's a very difficult position to be in, because, if you're trying to run to banks at that point in time, they're probably less likely to be assisting you, I would think, Harry.
I think you're right, Tony, unfortunately.
Yeah. The second one that I had was the right work and the right margins. And we understand that it's a very competitive market at the moment, and builders, there are some builders out there that are pricing quite cheap just to win work. I would argue, why even begin a job if you're not going to make a margin? It sort of defeats the purpose. What is the right margin? Well, obviously that's going to depend on the type of job. So, someone could be doing some large boutique homes that are, 2 or 3 million as a build. Others could be doing sort of smaller townhouses or units that, are significantly less. So we tend to find that, some people might think that the larger ones will have the larger margin. They will in dollar terms, but they won't necessarily in percentage terms. So the margin for them might be circa, somewhere between 15 and 20%, whereas those smaller bills could be, 20 to 25 or a bit more. And they're sort of the numbers you need to be looking at. And if you're not achieving that, you're probably going to struggle from a cash flow perspective. The other thing is the timing of those jobs can obviously affect your margin. Those larger jobs are sort of, 18 months, maybe some even 2 years, depending on the size. Obviously, those smaller jobs could be sort of 9 to 12 months. So you've got to really look at the picture from a holistic point of view and what your 12 months outcome would be from a margin perspective. But really zoning into the type of work that you want to be doing, the type of work you're good at, and the type of work you can generate a good margin on. That's really what every builder should be doing, not just grabbing any job because it's a job, but really looking at the type of work, the type of builds they want to do, maybe even the geographical location that they want to do them, and what they particularly do well, and really market that service and really hone into that.
Okay.
And the third item there is just really what matters to them, defining their success and building systems so the business, doesn't need them 24/7. So we can eliminate that burnout and they can actually enjoy what they do, which is, part of, number two there, doing the right, doing the types of work that you want to be doing, getting enjoyment out of it, and, actually having a life outside of, building and dealing with trades and dealing with suppliers, dealing with clients and dealing with councils, dealing with architects, engineers, et cetera, all who are looking at you to sort out the problem, and unfortunately, there's typically more than one problem on any given job.
Yeah. So the what matters to you is more about, are you working to live or living to work type philosophy? Is that what you mean?
Absolutely.
Yeah. Okay. Uh, Now the opportunities for the new year. So the challenges are probably well known to everyone, but the opportunities, hopefully, Tony, you can help us hone in on what to look forward to.
Yeah, well, as I touched on in that previous slide, Harry, better margins is something that we really need to be looking at. We really need to be looking at the type of job and achieving those margins that will, not only cover our overheads, but actually provide us with money in our pocket at the end of the day, and so we can enjoy the lifestyle that we want. I mean, the builders work hard. They don't do it, for the fun of it. They do it to establish a lifestyle for them and their family.
One of the questions that has come up, Tony, is, are you talking about gross or net margins?
I'm talking about gross margins on the job, and then obviously that will flow on. But really, they need to be looking at each margin on each job, and trying to achieve a number that, when you look at all of the jobs, say that you might forecast over a 12-month period, is that going to generate the amount of money that you need for your lifestyle? That's ultimately what you need to be aiming for.
Right. So gross margins on each job.
Yep.
Hopefully leading into a net margin for the business at the end of the year.
Correct.
Okay. Yep. Sorry, I just thought I'd clarify one of the questions.
That's okay.
Great. Thank you.
Obviously, smarter systems, we sort of touched on, managing a job, right from quotation through to completion. Having the systems to be able to accurately measure, scheduling, project tracking, the team, your labor, your materials. You need to have those systems in place. One, for the job to run smoothly, but two, to make sure that he's tracking based on what you've quoted and estimated, because it can very quickly get out of hand if you're not looking at it closely. And you might have thought you were going to generate a good margin on a job. A few things have gone wrong. You're stuck in the detail and the day-to-day on site and managing your labor and your materials and the client. But you're not sort of realizing that, oh, hang on, maybe we spent 5,000 more on this item, 10,000 more on this item. And by the time you get to the end of the job, your 25% margin gets whittled down to 15%. We've seen that far too often. So having systems in place to manage that is key.
Okay. And some of the systems would be getting your team productive as well, and not having your foreman running off and getting boxes of nails every 3 minutes from Bunnings.
Absolutely. And stopping off at McDonald's at least a couple of times on the way back as well.
Right.
You know, managing your team and having a really efficient team in place makes the job more efficient and makes the outcome more efficient. So whatever systems you need to put in place to do that, you need to do that. And when I say systems, everything doesn't always have to be computerized per se, but it's about the processes, who does what, when, how, etc. Because typically it's just left to the builder and he has to manage everything. And he'll say, oh yeah, you can run off to Bunnings to get that thing. But, the reality is it creates some problems and delays and more costs.
Okay. Talk to us about capital gains tax, negative gearing changes.
Well, this is the fun stuff. So our dear friends, the government, have decided that, despite telling us for many years that they would never make the changes, have decided that they will now make the changes. So I'm sure most of you know that the current situation is that individuals and trusts would generally receive a 50% capital gains tax discount on any assets that they've sold after holding for more than 12 months. The government have now decided that 50% discount would be replaced with a inflation indexation model for those future gains, and that a minimum tax would be 30% on the total gain is being proposed. And the assets are now going to have to be, existing assets are now going to have a valuation at 1 July 2027 with a pre-game portion based on the old system and a post-game portion based on the new. So this is a real problem, and it's a real problem for existing homes.
And it's a moving target still, isn't it?
Absolutely, it's a moving target, and the other, obviously, this relates to established properties. New properties will be able to still access that 50% CGT discount, but one issue might be that you think, well, I'll just knock down an existing home and build up a new one, and that classifies as a new one. Unfortunately, it does not. A new build on the same title, just replacing effectively existing home, does not qualify. So a knockdown rebuild with one dwelling being replaced by two or more dwellings, whether it's a duplex, whether it's 3 or 4 townies, that does qualify. And it qualifies for all of the properties, not just the ones over and above the original. So they do need to be new. They need to be more than one if you're doing a knockdown, and they will qualify. So that's great for new residential. The CGT is not particularly great for established properties. On a negative, sorry.
So what you're saying, the builder's best friend is the fact that in this policy, the property investors that want to build a property portfolio need to find builders that can build their property portfolio. That's the only way they're going to remain in that investment, isn't it?
Yeah, the demand is definitely going to switch to new property, no question, because that's where all of the tax advantages are. So all investors, well, I can't say all, but the vast majority of investors and the vast majority of developers will be looking at new property, and will need builders to be building all of these properties. And that's what the government want. That's why they've introduced this. They've said we're going to allow all new property to gain tax advantages, but no established property to do so. So that's really going to shift investors and developers. Well, developers are going to new property, but investors to new property. And so builders are going to be busy building these new properties.
Hopefully. And you never know, Tony, maybe builders can build their own properties. That's their superpower, being able to build stuff without having to rely on anyone else. So that might be another advantage for the builders as well, you reckon?
That's a great point, Harry, and that is probably key. And a lot of the builders that we look after and support are very much in that camp that they have traditionally done client work but have shifted to do their own developments because um, generally speaking, they eliminate some of those problems because they're their own client. So they don't have to listen to someone else to tell them what to do. They're listening to themselves. And they are, you know, um, in a better position to get a better outcome at the end because it's not just the builder's margin they're relying on, it's the potential sale and the profit in the development.
And on a positive note as well, lenders are quite focused on supporting the building industry. So the lenders are geared towards helping builders help property investors build more. Having said that, serviceability requirements are quite tight, but the balance to that is that lenders are looking for experience. They're looking for common sense approach. So the feasibility needs to stack up. The builder needs to have a full pipeline moving forward. If the builder's doing their own project, they need to have an exit plan on how they're going to repay the loan. But banks and lenders are quite focused on supporting the building industry at this point in time. It changes relatively quickly and it does go through peaks and troughs. But for the last, let's say, 3 months, the lenders have been focused on supporting the building industry, which is a positive thing.
That's a great thing, and this is why it's now important for all of the builders to have their financial affairs in order,
Mm.
because they will need them in order and in good shape to access the funding. So when they're coming to you, if they've got a nice clean set of books and potentially some forecasts and projections, if they're well prepared in terms of looking to access funding, they're more likely to have a positive outcome.
Oh, for sure. So the window of opportunities now basically is what you're saying?
Absolutely, it is. And builders should be setting themselves up. They should be really looking at potential new builds. What does that look like for them? What type of builds do they want to do? What sort of areas do they want to do them in? Do they want to do them for themselves? Do they, are they happy to do client work? So all those things they need to sort out for themselves in their own mind. Obviously, if they need assistance, with regards to looking at numbers, looking at lending opportunities, et cetera, we're only too willing to help. But they probably need to sort of work out what can they do to maximize their return and what do they want to be doing, and then that they can proceed down that path and engage all of the people they need to engage to make sure that they get there.
Which is the next steps, Louisa? So as Tony said, the next step is feel free to reach out and contact Tony. He and his team can help you with the cash flow, can help you with profits, margins, planning for the new financial year. He's probably a good first stop to make. And if you have requirements right away, my team and I are more than happy to help you with your finance and lending requirements. So, Tony, do you have any closing remarks?
Um, just what I just touched on, really making sure you're got your strategy in place, making sure you've got all of your financial affairs in place. And if you haven't, well, that's probably where you need to start, because the opportunity, as you said, is now, and they should take advantage of it. And those that do step in, so to speak, first will reap the benefits.
Wonderful. In the respect of time, we won't go through the questions now, but we will list the questions and have them available for those that attended and those that have registered as well. Thank you so much for your time. Much appreciated. This is the first of a series of webinars, so please feel free to email myself or Louisa topics of interest moving forward. Thank you very much, Tony, Louisa, and all
Thank you,
that
Tim.
attended.
Thank
Thanks.
you. Bye.
Thank you.